Today, mutuals can now join the capital raising dance, but what are the risks? Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and property news with a distinctively Australian flavour. The latest amendments passed into law last week extends the capital raising capabilities of mutuals in Australia via Mutual Capital Instruments, or MCIS. However, we are concerned by the extension of financialisation into the mutual sector, the potential higher risks it introduces as players compete for returns to investors, and the complexity of the financial markets they have to engage in. This could be a disaster. Frankly, this just continues the journey away from meat and potato banking and is a further illustration of the myopic view of the regulators, especially APRA. Rather than extending these additional capital channels, we need banking structural reform to contain the over-risky sector. This is the wrong strategy at the wrong time, especially as the housing sector tanks. Anyhow, this is what Moody's said on the 4th of April. Australia's Parliament passed the Treasury Laws Amendment Mutual Reforms Bill 2019, which amends the Corporations Act 2001 to allow mutually owned institutions to issue capital instruments. The development is credit positive for mutuals because it will enhance their ability to support growth, invest in technology innovation, and over time will also strengthen their competitiveness. In particular, the amended Act introduces a definition of a mutual entity, clarifies that demutualisation rules can only be triggered by an intended demutualisation and not by other acts such as capital raisings, and creates mutual capital instruments, MCIS, that are specific to the mutual industry to raise equity capital. MCIS will provide mutuals with an additional capital channel to respond to growth opportunities, supplementing the retained earnings that they've relied on to date. This additional capital channel is particularly important for mutual authorised deposit-taking institutions, mutual ADIs, which include mutual banks, building societies and credit unions, at a time when their profitability is under pressure. Pressure on profitability stems from competition for lower risk owner-occupied mortgages with principal and interest repayments, the mutual's core products. This elevated competition stems from a number of factors, including reduced overall loan growth, a reduced demand for investor mortgage loans in the face of potential changes to negative gearing and capital gains taxes, and tightened underwriting criteria at the major commercial banks as a result of public scrutiny during Australia's Royal Commission into misconduct in the banking, superannuation and financial services industry. Additional capital options will also help mutual ADIs build the scale and efficiency they need for technology investment, which is particularly important at a time when banking services are rapidly becoming technology-based. Compared with mutual ADIs, the large commercial banks have more resources to develop or acquire innovative products, digitize processes, and integrate new technologies into their business models. Technology-driven financial firms, or fintechs, are seeking entry to banking, while the Australian Prudential Regulator Authority, APRA, has established a framework that allows new entrants to begin operating at an earlier stage in their licensing process than previously. These new entrants are currently small and subject to regulatory constraints in taking deposits and making loans. In most cases, they have not yet built up a retail customer base of meaningful size. However, they could grow to challenge incumbents, particularly small-scale ones like mutual ADIs, over time. We do not expect, they say, mutual ADIs to swiftly ramp up their issuance of MCIS because their already strong capitalisation and the current low loan growth environment is likely to reduce their need for additional capital. And mutual ADIs' average common Tier 1 equity CET1 ratio is well above that of the major commercial banks, which itself is strong by international standards. Moreover, APRA has set a 25% cap on the inclusion of MCIS to CET1 capital, and has also capped the annual distribution of profit to holders of MCIS at 50% of a mutual's net profit after tax for the year in question. The prospect that the issuance of MCIS will remain limited will reduce the risk that mutual ADIs will significantly increase their risk profiles in an attempt to generate greater dividend returns for MCI holders. And mutuals will need time to amend their constitutions and build market recognition for MCIS. The experience of mutual banking peers in the UK also suggests that the process will be gradual. In the UK, mutuals have been allowed to issue core capital deferred shares similar to MCIS under the Building Society's Core Capital Deferred Shares Regulations 2013, but few have done so to date. And we expect, they say, that Australian mutual ADIs that already have a strong investor base in the debt market to be in a better position to issue MCIS. Now, that's all well and good, but I still believe that this is the wrong strategy at the wrong time. And remember that there is a Senate inquiry looking at the structural separation of banks. And I hold the view that the right outcome is to narrow the aperture of banking, not increase it further. And this flies in the face, I think, of trying to normalise our banking system. One of the key reasons why mortgage lending in Australia has grown so much is the bank's ability to finance that growth through unconventional means. And MCIS is just another example of this type of instrument. If you found this post useful or helpful, please like the post, share the post, add a comment or question. I read them all. And if you haven't yet subscribed, please do so to receive alerts on future posts. And before I go, just a quick reminder that on Tuesday, the 16th of April at 2000 or 8 p.m. Sydney time, we'll be running our next live stream event where you can ask me questions about finance and property. You can join the chat live or send your questions ahead of time via the DFA blog. The links are in the comments below. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.